Okay, just as we have already discussed, we have pointed out that if we are using the full goodwill method or the fair value method, then the formula would be to add consideration transferred to non-controlling interest at acquisition, less net assets at acquisition, then we get our goodwill at acquisition. At the year end, because goodwill is an indefinite asset, we then have to subject it to an annual impairment review. Therefore, when an impairment review exercise has been done, in this particular case, it was found that 10% impairment had resulted. Therefore, we need to reduce our goodwill with the 10% of the goodwill value to get a 200. So we have the goodwill at reporting date of 1.8 million. This impairment of 200 has to be shared between the NCI and the group. That's what happens in the full goodwill context. Let's move to the proportionate share basis. Now, the formula is that we use the consideration transferred, okay? All right? You can as well just incorporate the NCI, but in this case, you need to use the NCI percentage. All right, both formulas are going to give you the same solution either way. So if we incorporate NCI, then your NCI at acquisition should be 20% of the net assets of the subsidiary, which are 4 million from the question. Okay, the question was saying that the net assets were 4 million. So you know that this is an 80% subsidiary from your group structure. Therefore, the NCI should be 20%. So if you do that, 20% of 4 million, that's 800, okay? Then you less your net assets at acquisition. The net assets were 4 million. Therefore, the goodwill at acquisition should be 1.8 million. Less impairment to date, the 10% of 1.8 million, which is going to be 180. So our goodwill at acquisition should be 1620. So the proportionate share of net assets method calculates the goodwill attributable to the group only. So in your computations for workings number 4 and number 5, you need to understand that the impairment was only affecting the group and not the NCI in the context of the proportionate share of net assets method. So the full impairment is to be allocated to the group, which means in this case, the full balance should affect the group retained earnings. Now, you can do the same method again without the NCI. In this case, this is the ordinary method for computing the proportionate share of net assets method. So you have your consideration paid, then less the net assets at acquisition, then you get your goodwill 1.8, less an impairment, and you arrive at 1620, which has produced the same result as before. But let us understand the concept of grossing up. Okay, to begin with, An asset is impaired when its carrying value is higher than its recoverable amount. And what is a recoverable amount? This is the higher of fair value less cost to sell and value in use. Too technical again. Fair value less cost to sell is the amount that the buyers of the asset are willing to give us, less any legal cost that might be involved. Whereas value in use, this is the value we expect to gain to get the fair value of the income flows or income streams we are expecting to sustain if we continue using the asset. So the higher of the two is the recoverable amount. When goodwill has been calculated on a proportionate basis, then the purpose of conducting the impairment review is necessary to gross up goodwill so that in the impairment review, goodwill will include an unrecognized notional goodwill attributable to the NCR. Any impairment loss that arises is first allocated against the total of recognized and unrecognized goodwill in the normal proportions that the parent and NCI share profits and losses. Any amount written off against the notional goodwill will not affect the consolidated financial statements and NCI. Any amount written off against the recognized goodwill will be attributable to the parent only without affecting the NCI. If the total amount of impairment loss exceeds the amount allocated against recognized and notional goodwill, the excess will be allocated against the other assets on a pro rata basis. This further loss will be shared between the parent and the NCI in the normal proportion that they share profits and losses. All right, to put this together, let's continue with our workings. At the end of the year, an impairment review is being conducted on a 60% owned subsidiary. At the date of the impairment review, the carrying amount of the subsidiary's net assets were $250, and the goodwill attributable to the parent was $300, and the recoverable amount of the subsidiary $700. Determine the outcome of the impairment review. Okay, now just to be systematic, we know that the goodwill, which has already been calculated so far from the proportionate basis method, is okay. Goodwill calculated. This was 300,000. I mean, it was 300. Okay. However, we need to gross up so that we determine the amount of both the notional goodwill and the calculated goodwill or the recognized goodwill. So since this is a 60% on subsidiary, so to gross up this goodwill, we just have to divide by 60, 100 divided by 60, and we multiply this, so we get our notional, the total of notional and calculated goodwill, which is about 500. Once we have done this, we then have to determine if there is any impairment that has taken place. We know that the net assets of the cash generating unit here is that we are having the ordinary net assets of 250 plus the notional and recognized goodwill, which is equal to 500 as we have computed. So therefore, the total assets here, the carrying amount actually of the assets is 750. And we have already discussed or identified that an asset is only impaired if its recoverable amount is lower than the carrying amount, or if the carrying amount of the asset is higher than the recoverable amount. So in this case, the carrying amount is 750 and the recoverable amount is 700. So obviously there is an impairment of how much? Of 50%. I mean of $50. This is the impairment. And we then have to determine if the impairment is greater than or less than the total of the notional and calculated goodwill. In this case, we can see that 50 is less than 500. So in that case, we can safely say that the impairment is only affecting goodwill. This particular impairment would only, let me just say, would only first reduce the amount of goodwill before it extends to other assets. Are we together? Before it extends to other assets. So let's do that. Okay, so we are having our impairment. The impairment is $50. However, we know that the impairment is not going to affect the NCI, but the group. But how much of the group is going to be affected? We are going to be informed by the ownership percentage. In this case, we know that this is a 60% subsidiary from the question. This is a 60% subsidiary. So the impairment that is going to affect our retained earnings is only going to be $30. Right? Now, because we are using the proportionate share of net assets method, then therefore non-controlling interest is not going to be affected by the impairment. So whether in the statement of profit or loss, you're not going to affect the NCI balance there, or in the statement of financial position, you're not going to affect the NCI. I have explained in depth this part in your notes. Please refer to them. Okay, now let's move on. What about if we use the full goodwill basis? What is going to happen? Okay, I've again explained this part that the impairment is not going, the goodwill is not going to be grossed up and so forth. They're not going to use all that. It's just the ordinary impairment which we have done before. There is just the method I showed you. It's just the same. No grossing up is going to take place. However, the impairment is going to affect both the parent and the NCI. Okay, so that was the the explanation that is essential on that part. Now let's talk of this interesting aspect that is going to affect our passing potential in the upcoming exam, and which is very necessary and essential. Okay, there's some students who are actually in need of me explaining the previous example. So okay, let me just take your 1 minute to do this example. because I don't want you to feel like you are being neglected or being taken for granted. All right, your continued viewership is very important to us. So we need to have you aboard or on board. So please don't go anywhere. Let me take you through. So this question is saying at the year end, an impairment review is being conducted on an 80% owned subsidiary. At the date of the impairment review, the carrying amount of the net assets were 400 and the gross goodwill $300, of which 40 is attributable to the NCI, and the recoverable amount of the subsidiary is $500. Determine the outcome of the impairment review. Okay, so here we just go straight to our working. So we start with the available net assets, which we have according to the question. The net assets were $400, so 400, and the goodwill we have is 300. So the total assets of the income generating units, cash generating units, CGU, is 700. Okay, but remember, this is the carrying amount of the CGU, the carrying amount, okay, and the recoverable amount is 500. So impairment here is how much? The impairment is 200. That's the impairment of this particular cash generating unit. Okay. So that's the case. Okay. Now the question is, how are you going to allocate and so forth? Remember, we have already answered the part or the requirement of the question. However, the examiner might want to know how you're going to allocate this. So this 200 or the impairment loss, this is actually an impairment loss, which is going to be allocated between the group and the NCI, right? And the group, you take 80% of that and you charge it to the group retained earnings, and 20% of the loss to be charged to the non-controlling interest. As simple as that. No need for, to gross up and so forth. All right, because we will be using the full goodwill method. Now let's talk of these issues. Cost of investment, recognition and measurement. What is a cash consideration? Or how are you going to account for a cash consideration in a consolidation question? Here, the cost of investment is the amount which was actually paid or transferred by the purchasing company. So in their records, they are going to debit the cost of investment and credit cash. In a share exchange or share for share exchange, the cost of investment is going to be the market value of the shares transferred. Adjustments are only required when not recorded by the holding company. So the general or the usual accounting entry is going to be debit the cost of investment, credit share capital, and share premium. What of deferred consideration? Here, payments will be made in future. So a deferred consideration would be referring to a situation where the acquirer will promise the acquired shareholders, the acquired company shareholders, that they will pay them unconditionally in the future, whether they are going to make losses with this subsidiary or not, they are going to pay them. So the cost of investment is recorded at present value of the expected payment, and unwinding will be recognized in consolidated retained earnings. So later on, we will have to unwind. Okay, why do we have to unwind? Remember, the present value is actually going to be the value today of a future income stream. So, for example, if we are going to be paid 1 million in 5 years, we then have to consider the time value of money and so forth. So you might discover that the 1 million in 5 years' time is equal to 600,000 today. Okay, that's the 600 will be the present value of 1 million in 5 years. So it will be the 1 million in 5 years will be worth 600,000 today. So what does that mean? It means that at every year end, we need to unwind, because we would have discounted the 1 million to present value terms. So we need to unwind so that we retain, as we approach 5 years, the amount to be reflected in our books should also be approaching to 1 million, the amount we are going to be paid. So unwinding would be, adding back the reduced value of 600 should be systematically being increased as we approach the years of maturity. As we approach maturity, that is the time when we receive the 1 million. Are we together? Don't worry, we'll do an example. So the double entry is you debit cost of investment, credit deferred consideration, or in present value terms, and at year end, debit retained earnings, credit deferred consideration to unwind the discount. Okay, as we will be increasing the discount, the deferred income, so we'll be unwinding it. Contingent consideration. Here, payments will be made in future upon occurrence of a certain event. So this one is a conditional payment. Must be measured at fair value at the acquisition date. So debit cost of investment, credit contingent consideration, and it is measured at fair value with changes made in retained earnings. What of the loan or debenture? It will become part of cost of investment only if issued as part of consideration transferred. So you debit consideration, cost of investment, and credit the loan. So let's do this example. On 1 October 23, Rudo acquired 90 million of Louiso, 150 million $1 equity shares. The acquisition was achieved through a share exchange of 1 share in Rudo for every 3 shares in Louiso. At that date, the stock market prices of Rudo's and Louiso's shares were $4 and $2.50 per share, respectively. Additionally, Rudo will pay $54 cash on 3rd September 2024 for each share acquired. Rudo's finance cost is 10% per annum. So that aspect of finance cost or the cost of capital should actually be, should ring a bell in your mind that this question is talking about present value, about discounted cash flows, something like that. The, the retained earnings of Luiso brought forward at 1 April 2003 were 120 million. Profit for the year is 80 million. Determine the cost of investment. So let us determine the cost of investment here, because we can see that there are two methods which are being utilized. There is the share exchange method, okay, or share for share exchange, and then there is also an issue of which method is here again. Additionally, you will pay 154 cash. There is also a cash consideration, $54 cash on 3rd September for each share acquired. Right. So this is actually a deferred consideration, as you can see. It's not a cash consideration as such, but a deferred consideration. So we have got a share exchange consideration and a deferred consideration. So let's then determine, we then have to add them up. You have to add the amounts and come up with the total figure to be considered as cost of investment. So let's do that. Okay, now let's start with the share exchange. All right, so the group structure might assist us. 90 million of 150 million. This is how much. Let me use my calculator to see. Okay, this is 60%. So therefore the NCI is how much? 40%. All right. Now, what about the number of shares? Number of shares issued. The number of shares issued. This guy issued 1 share for every 3. One for every 3. Okay, multiplied by how many shares? We're talking of 90 million shares. All right. So 90. All right. This means 30 million shares, right? And what about the value acquired? This obviously should be 30 million multiplied by the share price of the acquirer. Share price of the acquirer, in this case, that's Rudo. Rudo's share price $4. Okay, so the value of shares issued rather. Actually, it's issued because we are using the value, the share price of the acquiring company. So it's actually value of shares issued because we are paying the shareholders of the acquired company. So the value of shares issued, okay, is 120 million. What about the deferred consideration? Let's do workings for the deferred consideration. But before we do that, I think let us do the double entry that is necessary here, just for interest sake. For this particular share exchange, we debit the cost of investment. Okay, the cost of investment so far is 120, and we credit because we have issued shares, so we need to credit the share capital. Right, the share capital here should be the nominal value of the shares. Now we have issued 90 million shares, I mean $1 shares, but they've now fetched 120. I mean, the number of shares which we have, actually we've bought, this one is the shares which were bought, but the number of shares which were sorry, I'm mixing up things there. That's the number of shares which were issued. All right, I'm correct there. This is the number of shares which were bought, but the number of shares which were issued, we bought these, the 90 million were bought from the subsidiary shareholders. However, we used our own shares. We issued 30 million shares. So I'm saying 30 million were $1 shares. These 30 million were $1 shares, right? They were $1 shares in terms of their nominal value. So we are going to credit 30 million there. These are in dollars as the nominal value of the shares. Then the balancing figure should be the share premium, which is 90. Remember, the debit and the credit should balance. Our debit was having $120 million as the cost of the investment. Therefore, the credit side should also total 120 million. How can it total that? How can it balance? We know that the share premium nominal value, the share capital nominal value was 30 million. So the balancing figure should be 90 million. Are we together? So that was the very important point I wanted to put across. Now, let's compute the deferred consideration using the information in the same question, because if we don't do that, we are not likely going to succeed in whatever objective we have. Okay, so to proceed, we are now in this part. That's the part where we are at. Additionally, Rudolph will pay $54 cash on 30 September 2024 for each share acquired. Rudo's finance cost is 10%. So this is a deferred consideration. So amount to be received, amount to be paid rather, to be paid, that's $54 per share multiplied by how much? We now know that we are talking of the number of shares which were acquired. This time, we're talking of 90 million shares. Acquired shares. Okay, we acquired 90 million. So, and we are going to pay for this using $54 cash on a future date, that is 30 September 2024, almost 1 year later. All right, we're going to pay one year later. So we need to consider the time value of money. So let us first of all determine the total we are likely to pay here. That's 1.54 multiplied by 90. That's 138.6 million. But we are going to be paid this amount after 1 year, so there should be some time value of money. So the present value of this, the PV of this, should be 138.6 million multiplied by 1 divided by 1. That's divided by 1 plus R. And our R, the rate here, the discount rate is 10%. Okay. To the power n, and our n is just 1 year. Okay. To the power n, all right. So we are going to get how much? Let me use my calculator here. 138.6 multiplied by 1 over 1.1. It comes to 126 million. So we're going to debit cost of investment, 126 million, and we're going to credit what? Obviously, we're going to credit the deferred consideration, 126 million. This is on the date of acquisition. What about at year end? How are we going to record this? At year end, remember, we are going to unwind. All right, so there is going to be an increase of these figures because we will be moving towards the 138.6 million. So a transaction that is going to be captured in our statement of profit or loss, SPL, is going to be, we're going to debit the retained earnings. Okay, we're going to debit the retained earnings with how much here? All right. We are going to debit the retained earnings with the unwinding of 126 multiplied by 10%. So in this case, that's 12.6 million. Okay, and we are going to credit our deferred consideration with the same amount of 12.6 million. This is the amount which, when we post it, it will increase our amount from 126. Sorry, where's the pen? From our 126 to 138. How? That's 126 plus 12.6. This will come to 138, the amount we are going to pay. Okay, so like I said, unwinding is just the process of bringing the present value to the future value. So why are we debiting the unwinded figure to the retained earnings? Or why are we debiting the retained earnings with the unwound figure or the unwinded figure? This is because we treat the unwinding as a finance cost. So it will be having an effect of reducing the retained earnings. Okay, I think we have done justice. So the total cost of the investment should then be the deferred income, the present value here, the present value of this present value added to so what's going on? Added to the 120. So let us add those two figures and get our COI. So that's 120 million from this plus 126 million, the figure which we have just calculated here. And this should come to 246 million. Okay, that was a whole lot of processes, but well, with practice, you need to know that that's how you obtain those figures. We have discussed about the NCI computation. Please just refer to that part of the video. All right. Just the simple process. We have done that. Let's talk of this important issue: acquisition media. If a parent entity acquires a subsidiary media, the net assets must be calculated at the date of acquisition. The net assets at acquisition can be calculated as the net assets at the start of the subsidiary's financial year plus the retained earnings for the part of the year up to the date of acquisition, together with any fair value adjustments at the date of acquisition. To calculate this, it is normally assumed that as profit after tax has accrued evenly throughout the year. So that's the assumption which you should have or you should make when you'll be computing these figures. It might become too econometric, too challenging, and you won't be able to solve any question in this particular exam. So certain assumptions are considered valid. With that said, let's have a look at this particular example. Right? So just read this part. I'll be just pausing the video. As you guys will be reading through, you can as well pause the video there so that you'll finish reading it and then proceed with me. Okay, ladies and gentlemen, let us continue with our journey. This question, I've given it on the screen so that you get more practice in attempting such big questions. Okay, because in the examination you might as well be given such a long question, especially on your part, on your section C. Right, so that's the question for you. There are certain pointers I want to highlight as we do this question. We're not going to solve the complete question, but I just want to point, especially on the asset side, because of our time. And what you need so far is just an appreciation of what is going on. Okay, now if you master the asset side, then you're not going to fail to master the uh, equities and liability side. Okay, so the full question is this was the first part, and this is the last part. Okay, as you can see, the last part is about the additional information which you might need to solve the question. The question was saying you need to prepare the consolidated statement of financial position for the Massey Group as at 3rd December 20x4. But I want you to appreciate the importance of debts. All right, so on 1 March 20x4, this company, Massey Co., bought 80% of Ferguson. Yet I've already indicated that the year end was 31st December 2024. So the company Ferguson was bought midway through the year. So these are mid-year acquisitions, which are very dangerous if you simply just skim past and decide to just attack the question with your assumptions or with your own views and not the examiner's views, you are likely to fail. So dates are very important in consolidated financial statements. All right, so Mazi Co. bought 80% of Ferguson, paying 180,000 cash on that date and agreeing to pay a further $1.21 per share on 1 March 20x6. So you can see that this we are having an issue of cash consideration. Okay, cash consideration as well as deferred consideration. So we have all this information before our eyes. Then we need to then flow, as we are now knowledgeable of how to compute a cash consideration, actually the cash consideration has been computed for you. All you need is just to slot in the figures as you attack the question. However, the deferred consideration is the one we need to calculate here, right? The deferred consideration. Because for you to calculate whatever the goodwills and everything, you need to have the consideration figure. If you don't have the consideration figure, you are not going to ask the question. So what is going to be paid? What is the future value? The future value to be paid, they are saying that you are going to pay $21 per share 1 March 2026. That is almost 2 years later. We bought 80% of Ferguson. So 80% is how many shares? Because you need to multiply that figure with the $21 cents. So if we bought 80% of 60,000, remember these are $1 shares. So obviously the 60,000 represents the total number of shares for this company, outstanding for this company. So that's 60 multiplied by 80%. It means that there were 48 shares. Okay, 48,000 shares rather. So the amount we are looking at, let us use our calculators. The amount we are looking at, okay, let's this calculator of mine. This is tricking. That's $21 multiplied by 48. So we are looking at 58,080. This is the future value we are going to to pay in 2 years' time. So what is the present value? The present value should be 58,080 multiplied by 1 plus R. Our R is how much? It's 10% to the power -2 this time. Okay, remember previously I said multiply by 1 over 1 over 1.1 to the power a positive figure. Why? Because it was a denominator, but now I've expressed it as a number which is not a fraction. So you just have to be used to such type of arrangement or expressions. Okay, so if we multiply there, we must get something showing some reduction. The figure should have been reduced to 48,000. So this is the amount of consideration in present value terms, and that is the amount that has to be recognized. So our consideration now, our cost of investment should be the cash consideration of 180 plus 48, and this has to come up to 228,000. So that's the thing. Okay, but we are told here that with my pen, only the cash consideration has been recorded. Okay, so which means if you are looking at this 230, we are only having 180 recognized, which means the 50,000 is for something else. Okay, is another investment. We don't know that investment yet, but what we know is that in that 230 there is 180,000 cash. Why? Because only the initial investment of the subsidiary, in the subsidiary of $180,000 cash has been recorded. Okay, so we need to dig deeper to understand what is going on. Okay, however, when you prepare your consolidated financial statements, you then have to factor in the deferred consideration amount of 48,000 in your computation for goodwill and so forth. Excuse me. Okay, so let's move on. I think these are just the initial workings. You need to play around as you be looking at the data to determine what is going on. Okay, now I think for us to understand the the origins of the 50,000, which we do not know whence it came from, I think it is better if we read the additional information. So the first item there is talking about the inventory of Mercy, which includes 18,000 of of items purchased for cash from Ferguson at cost plus 20%. So there were inventory with 18,000. Okay, so the inventory worth 18,000, which was purchased for cash. All right, we are trying to, to understand what's going on. Maybe after we read everything, we might then be able to determine whence the 50,000 investment came from. All right. So let's first attack the first item to see. Here we are only interested in the impact of that transaction. All right. So here we are being led to the path or the, I mean, a provision for unrealized profit or just the UP, unrealized profit, which is going to be 18,000 multiplied by 20 plus, over 120. So that's the unrealized profit there in that, because the items were bought from Ferguson, a subsidiary, and you now know if it is the subsidiary that has sold the items to the parent, then we are going to debit the retained earnings. All right. Also debit the non-controlling interest and crediting stock. Are we together? These are the items which have been sold from the subsidiary. Okay, so 18,000. Let me try to calculate the provision. All right, so that's 3,000. We are looking at 3,000. And this has to be shared between the NCI and retained earnings at using the percentage ownership. And we know that this is an 80% subsidiary. So the 80% is going to be 2,400, which is going to be our retained earnings figure, and 20% to NCI, which is going to be 600. And here the whole 3,000 going to be credited to stock. So that's how you'll be attacking these questions. So the NCI is fine. Okay, so we have dealt with item 1. However, it did not give us the answer to the origin of the 50,000 investment we are worried about. So let's read on the notes. But as you'll be reading, please try to be doing the workings, because time might get out of your sight before you write anything. So you need to write these workings. They can actually accumulate some marks for you. All right, item 2 is saying, on 1 March 2024, Mazi transferred an item of plant to Ferguson for $30,000. So the parent transferred an item of plant for $30,000 on the date of acquisition. Its carrying amount at that date was 18,000, and its remaining useful life was 5,000. Okay, don't don't misconstrue this transaction to be referring to to be part of the purchase consideration. No, the examiner is silent about, and it will be very weird. However, you need to take it as referring to some form of arrangement for, some form of creative accounting, because they might want the gain sustained here to reflect good on the financial statements, something like that. So this is another version for PEP, or unrealized profit. When when one member of the group sells to another member, that type of transaction, whatever gain that was realized, should be eliminated. Okay, so in this case, we need to reverse. I mean, we need to eliminate the gain. So what was the gain? It was 30 minus 18, because the transfer price was 30,000, but the carrying amount was 18. So therefore, the gain was 12,000. So okay, so that's the gain we need to eliminate, ladies and gentlemen. Okay, now we are not going to stop on on eliminating the gain only. We also have to eliminate any depreciation that was charged, or to reverse the depreciation. So depreciation to be reversed should be, the question was saying its remaining useful life was 5 years. So it has to be matched with whatever gain that was recognized. So a gain of 12,000 was recognized here. So the associated depreciation with that gain was 12,000 divided by the number of years. All right, the number of years here was 5 years, which means every year they were charging a depreciation of 2,000. So this has to be added back. So when you'll be doing your PPE computations in the statement of financial position, you need to add back this figure, but you need to eliminate the 12,000 has to be eliminated. So the 12,000 gain has to be deducted, whereas the depreciation that was charged should be added back. That's elimination. Okay. So we are done with item number 2. Let's move on to item number 3. The Massey Group values non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 20% non-controlling interest was 55,000. So that one is just general computation. We'll do that working. We'll use that figure, so we'll be calculating our goodwill. Any payment loss of 4,000 is to be charged against the goodwill. We'll also consider that figure, so we'll be computing our goodwill. Ferguson earned a profit of 24,000. That again, we'll use that figure as time goes on. On 31st December 2024, Massey acquired 80% of Ferguson's loan notes. Aha, this is an investment. If they acquire loan notes, it means to acquire a loan note is actually to issue. It is actually to borrow somebody, or let me just say to lend. Actually, yes, they lended out money to loan holders. Okay, so they become they themselves become a loan holder. They give out money so that they get a loan. Okay, no. So in other words, they gave out money and become loan note holders. So in other words, this is a financial asset. They created a financial asset or a financial receivable. In another way, we are saying they bought loan notes. To buy loan notes is like somebody who wants to borrow money from you. They give you the loan notes which are tradable. All right, they give you the loan notes, you hold the loan notes, you give them money. All right, you will use those loan notes as your license to force the people you give out your money for repayment, something like that. Okay, for you to make a follow-up, or for you to force them to repay you, you then have to use those notes which you are holding as uh, the the license for you to get your money back. Right. So in this case, they acquired 80% of their subsidiaries loan notes, which means they loaned their subsidiary money, and they held the loan notes that subsidiary was holding. All right, so they gave their subsidiary a loan. Are we together? Yeah, that's what happened. That's what happened in the layman's point of view. All right, so how do we treat that? Of course, that was a financial asset which was created, right? Financial asset was created. Um, all right, so in this case, we have to treat that one as an investment, a financial investment or financial asset. So we have found the origin of our 50,000 partly. All right, so how much was actually bought as an investment? All right, so let me come back to the question. Let me go back to the question. So we are saying here, if they have acquired 80% of this amount, remember, this is the amount we are talking about, all right? To Ferguson, it was a loan, all right? Ferguson was already having this particular liability, but the parent bought that liability, all right? So in other words, the parent actually relieved Ferguson of the responsibility of repaying by giving Ferguson the money. All right. So in other words, although there might not have been a movement of money, the parent actually assumed the responsibility of repaying that amount. All right. So they bought 80% of this, which means 40,000 has been found. Okay. So it means if 40,000 has been found, therefore the remaining investment is 10K. 10,000 is now missing or requires some explanation. So the 10,000 could be treated as a simple investment. So the 10,000 now can then be safely treated as a simple investment. Why? Because we have found the origin of the rest of the monies there. We don't know that 180 was a cash consideration, and the 40,000 refers to the loan notes which were acquired by the parent company from the subsidiary. Then we can safely say the remainder should be a simple investment. All right. So this item, the seventh item here, is actually telling us that what is the parent is having a receivable, or is recognizing a receivable of 10,000. The sub is actually not in agreement. The sub is recognizing a 6,000 payable. Why? Because there is a check on transit or a cash on transit of how much? Of 4,000. All right, so what needs to be done is that we need to debit the cash in transit of 4,000. All right, and credit the receivables, the parent's receivables, so that of 4,000, so that the parent should also have a balance of 6,000, and these become current accounts which will cancel one another. All right, so which means in the current assets of the parent, in the receivables of the parent, we also have hello. Yeah. Hello. Okay. All right. So we also have to cancel the 6,000. All right. So these in both the current the trade payables should be reduced by 6,000, and the receivables should also be reduced by 6,000. All right. So you will see as I will be taking you through the asset side of this statement of financial position. However, the main point I want to highlight here is that these are current accounts which should be eliminated from the group consolidated financial statements. It's as simple as that. All right, so now let's start to do our mainstream workings. We for the group structure, we need not to waste much time on that, because we now know that this Masai is the parent, and our Ferguson is the subsidiary, and this is an 80% subsidiary where the NCI is going to be 20%. We know that. Okay, so our working number one is solved already. So this is working number one. Now, working number two, we can combine it in the examination because of pressure. So working number 2 and 3 can be combined as a computation for goodwill. Let's calculate the goodwill for this wonderful company. It has been a good company for us because it has assisted us to know better this consolidated financial statements mystery. So our formula for calculating goodwill is that we start with the fair value of consideration paid or to be paid. Okay, remember we have got the cash consideration of how much? The cash consideration was 180,000, and the deferred consideration has been found to be how much? It was around 48,000. Okay, 48,000. Okay, you should have in the exam, you can just pick this figure 228, because there won't be any time to dilly-dally. So your 228 is here, and then you add your NCI at acquisition. NCI at acquisition, and this one was straightly given by the examiner free of charge, gave 55,000. So what is the total there? Let me use my calculator, please. So that's 283. Then less net assets at acquisition. Net assets at acquisition. All right. You can just share capital. All right. If there is any share premium, you need to slot in those figures, and if there's been any fair value adjustments, what you need to take care of those things. The other thing you can use for this net asset, you can just follow the okay. All right, so we just have to continue with our scenario, with our workings. All right, so let's first slot in these figures, the share capital and the share premium. As you can see on the screen here, the share capital was 60,000 and the share premium was 5,000. So we just have to slot in those figures, 60,000, 5,000. Then we also have to slot in the figure for retained earnings. Now, for the retained earnings, this is the figure, one of the figures that I have already highlighted out upon the start of this video, that they are expected, retained earnings are expected to change. They're like other figures for reserves, they're expected to change. But for the share capital and share premium, the assumption is that they normally don't change over time. Excuse me. So the retained earnings, we look at the retained earnings figure at reporting, less any pre-acquisition retained earnings figure. So from the question, we can see that the retained earnings at the reporting date were 148,000. All right, just for clarity. All right, I'm sure the figure is now clear. So 148. We slot in the 148,000, deducting the pre-acquisition retained earnings figure, any pre-acquisition retained earnings figure. If we look at the question, okay, the first paragraph is not giving us the information. Let's look at the second paragraph. The additional information. Okay, we can safely assume that when this company was acquired, it had no retained earnings. All right. However, we then have to consider all right, actually we need to compute those the pre-acquisition retained earnings. Let us compute those ones, because we want to determine the retained earnings at acquisition. Actually, that's the figure we need. So for us to compute that, we then have to deduct the retained earnings for the year from the closing retained earnings balance. All right, so the closing retained earnings balance was 148,000, as I have already input there. So we then have to deduct that 24,000 from this figure. But remember, this 24,000 is for the full year, right? The 24,000 was for the full year. So actually, the assumption is that the company has been trading, so it had already its own profits, which have accrued. So I just have to correct that statement. To recorrect what I've already stated, that the company could have been acquired without any returned profit. Just the point of correction. The figure here is actually indicating that this company had been making profits throughout the year for the assumption to be valid. So we only have to take the 10 months profit. 10 months profit here. Okay. So the 10 months profit can be taken by multiplying 24,000 by 10 over 12 months. So we need to deduct that profit which has been made during the year from the closing retained earnings balance as being reported by the statement of financial position at 31st December 2004 for us to arrive at the retained earnings figure at acquisition. Remember, we are calculating the net assets of the subsidiary. So we also need to deduct. So we just have to continue and with the working and say less the 12,000. Remember, there was a 12,000 figure we talked about, which relates to note number 2. Remember, note number 2 was telling us that these guys transferred an item of plant to Ferguson, to the subsidiary, on the date of acquisition. All right. So the impact there was that this was going to increase the retained earnings because the parent was going to recognize a gain of 12,000. Remember, all right. And also the net assets of this particular subsidiary was also going to be increased in this. In that arrangement. So we are saying that we need to eliminate that. We need to remove that transaction. So we are also going to reduce the net assets figure. So the net assets has to be reduced by 12,000. Then we close our bracket. So this means that 148,000 minus 24. So let me just restate. This means 148,000 minus 24,000 multiplied by 10 over 12. What do we get? 24,000 multiplied by 10 over 12. That's 20,000. Okay, minus 12,000. Then we get the figure we need. Okay, this is the figure we need. Remember, we are on a continued working. This is a continuous working, right? We are still continuing. We are calculating the net assets at acquisition, right? So we are going to get what figure there for the retained earnings? 148 minus 20 minus 12, that's 160. Okay, and do we need other adjustments? Okay, I think we are done. So the 116 is actually in thousands. This is 1,000. 116,000. My computer is now misbehaving. So I think we need to add the two figures, 60,000 plus 5,000 plus 116,000. So what do we get? That's 181,000. So we then have to deduct 180,000 from 283. From 283,000 from this figure. So 181 from 283, that's 102,000. And that's the goodwill at acquisition. But we are also told that there was an impairment from the notes. Note number 4 is saying that an impairment loss of 4,000 has to be charged at the year end. So we come here and say impairment 4,000, and we are left with, let's use the calculators again, 98,000. This is the goodwill to appear at year end. The goodwill to appear in our financial statements is this one. Okay, so since we are only going to be worried about the asset side for now, then I think we just need to do the balance sheet itself, because the other workings, the non-controlling interest, the retained earnings, those ones are on the equities and liabilities side of the statement of financial position, so we just have to ignore them. You can continue to do that part using the information I've presented there. You just have to send me the completed statement of financial position with that particular side, so that I review it for you. Right there, I can, that's for free. It's for you, my YouTubers. You can just do that, and then I will mark you through. All right. So let us continue. All right. So let's do the statement of financial position. So as usual, the examiners would want you to just give the name of the company on top there as the heading, Mazi Co. I mean, this is now the Mazi Group, because remember, sorry, Mazi Group, Consolidated Statement of Financial Position as at 31st December 20x4. You need to write this in full, otherwise you are going to be penalized, because the examiners don't like you to shorten the name of the statement. Okay, you need to write it in full, statement of financial position. If you show them that you are tired, they're gonna give you a 46% for that. Okay, now for our assets, ladies and gentlemen, we are going to start. I'm going to say assets, right? Then we can start. You can just be informed by the way the examiners have listed their assets. All right, you start with the proper plant and equipment. Very simple, isn't it? Okay, PPE. All right, and I've already indicated that you need to add. That's 275 plus 230. Just take that 275 plus 230, and then you have to factor in the adjustments as you have already calculated. All right. So I still remember there was a very important adjustment which we talked about, and that was relating to the gain which was made when the parents transferred an item of property, plant, and equipment to the subsidiary. Okay, and we say that they made a profit of 12,000, right? And any depreciation associated with that has to be added back. Now, in this case, we need also to consider the time apportionment. So the depreciation charge of 2,000 has to be adjusted for the time apportionment. Remember, this subsidiary was acquired midway through the year, so we can't charge, add back the 2,000. Okay, so the first step which I had omitted when I arrived at this is that I should have shown you that we need to time apportion. So we should say 12,000 divided by 5 multiplied by 10 point, 10 over 12, so that we arrive at 2,000. Okay, so that's the time apportioned depreciation charge. Okay, so let us go back to our SFP. So we need to deduct the 12,000 profit that was made on the transfer of that plant, and then we also have to deduct, to add back the depreciation that would have been charged in respect of this plant. So that's the 2,000 which we need to add back. Like I said, consolidation is an issue or an aspect of adding uh, across the lines. Okay, you just have to add across. That's consolidating. So let us add these figures and determine what amount are we going to get on the total PPE value. So that's 275 plus 230 plus minus 12,000 minus plus 2,000. So that should lead us to $495,000. We move on to the other aspect. Obviously, for you not to forget, you just have to slot in the goodwill figure. And this one, we have already calculated it to be 98,000. All right, and other investment, obviously, we have got that investment which we said, because we couldn't find any evidence about where it has originated from, this and that. We then have to just, we need to treat it as a simple investment. Okay. So investment, let us just say other investments, 10,000. Okay. Somebody might then ask and say, okay, fine, you have indicated that when the parent acquired the loan notes, they had created themselves a financial asset. Shall we then have a financial asset in this case? The answer is actually no. We're not going to have a financial asset here, but rather we're going to have a financial liability. This is why. Let me just explain to you. When the parent acquired the loan notes of the subsidiary, that type of transaction is an intragroup transaction. So by default, it should be eliminated. Okay, so the 40,000 which was acquired from the subsidiary should be eliminated. Okay, because in this case, the parent is having a receivable, or let me just say a financial asset, whereas the subsidiary is having a payable, a financial liability. So these should cancel each other. All right, so for the purpose of examiners to see where you got this 10,000, you need to just say, okay, initially we were having 230 from as the investments total. It was 230. So you need to show the examiners how the 230 disappeared. Okay, minus the cost of investment, which we calculated to be 228, if you can still remember. I mean, not this one, not this figure, but actually 180. Okay, let us deduct the 180 because that was the amount that was recorded in line with the 230. The question said that this was recorded. This had been recorded, right? Had been initially recorded. So the 180 should be the figure we have to play with. Okay, 180, and then the 40,000, which is the intra-group. Just have to say intra-group elimination. Intra-group elimination. We need to eliminate that, all right? So this also means that on your non-current liabilities section, you need to eliminate that, all right? And then we also have, so it means that we are now left with 10,000. If you punch these figures, 230 minus 180, let me see, 230 minus 180. Remember, the 180 is the cash consideration, which was already recorded at the time of acquisition, minus the 40,000 intra-group, which took place during the year. Remember, an intra-group transaction has to be eliminated and we'll be left with 10,000 there. Okay, please just bear with me. Okay, and then let us move to the current assets. This way, non-current assets. Now let's move on to the current assets. We can start with the stock, move on to the receivables. All right, but like I said, to be just systematic, you just have to follow how the examiners have presented the information, but it seems that I'm still in the right direction. So we conclude with the cash. All right, now you first of all have to slot in the figures as given in the question, because this is consolidation, so it's adding line items. So that's 30,000 for the inventory plus 35,000 for the sub. 30 plus 35. All right, then you need to then go through the notes, the additional information, all the workings you have done to determine if the stock figures need not an adjustment. Okay, there has been this working which we are about to forget. There's been the PEP, okay, the provision for unrealized profit, or the unrealized profit UP, okay, which we determined to be 3,000. So we just have to consider that. We need to eliminate that. Minus 3,000. So then if you do that, it means that your figures are now ready to roll. So that's 30 plus 35 minus 3,000 minus 3, so that's 62,000. Now let's get to the receivables. We've got 40,000 plus 40,000, okay? 40 plus 40. But we also need to consider to eliminate, there was cash on transit, if I still remember, I think we calculated something about these receivables. Mm, it was our computation. Which means we have not been very, very systematic. All right, yes. Here, if you still remember, this is where I put that information. Okay, we need to credit the receivables because this was the cash. We were debiting cash here, but in terms of the receivables, we need to reduce the receivables by 4,000. We also have to cancel out the current account of 6,000. So we come here and say we need to remove the 4,000, which was the cash in transit, and the 6,000 current account. Sorry, I'm putting my figures not in thousands, but in units. So, okay. All right. You can as well describe the figures as you'll be writing them so that the examiners will know what you mean. So that when you make some errors along the way, you won't be penalized. So let me just try to, to slot in where the information about these figures. So 4,000. Okay, guys. I'm sorry I've been experiencing a machine breakdown in the past 3 or so minutes. So I had to cut the video and try to, um, find out what was going on. But I hope I'll finish the session smoothly as expected. Okay, I was saying that uh, there is need for you to uh, put some explanatory notes to your figures, or just have to, link them to your workings. For example, if you have been uh, doing, if you're having a figure related to a certain working, just have to indicate that this is from working number 2, something like that. Similarly, if on the receivables here, if the figure is also referring to a certain working, you can as well say this is referring to working number 5. Okay, but in this case, we didn't do that working. We don't have that working number 5. So it is advisable that you just have to link or um, to do some notes, um, or just to input some descriptive text next to the figure. For example, in this case, the 4,000 is linked to the amount of cash in transit. So you just have to say CIT, okay, and then you need to deduct as well um, the 6,000, which is, sorry, the figures are not in thousands. I've forgotten. It's just a 6, a unitary 6. So just have to say 6,000. All right, and you tell the examiner that this is a current account, not a current asset, but a current account. So the current account has to be eliminated. Then you close your brackets. Okay, so let us determine the total figure there. We're having 40 plus 40 minus 4 minus 6, and this should give us 70,000. Then the cash, we do the same. We just have to multiply, to add item by item. So if we come to the cash, we have got 5,000 plus 3,000. Okay, 5 plus 3 plus the 4,000 cash in transit. Okay, and this should actually give us 12,000. So, ladies and gentlemen, these were our assets. So you get your total assets figure. So let us add from 495,000 plus 98,000 plus 10,000 plus 62,000 plus 70,000 plus 12,000, and we get our 747,000. So that was our statement of financial position, ladies and gentlemen. I hope you have been assisted. The asset side. Now I want you to do the equities and liability side to determine if you are going to come up with this particular figure, 747,000. If you do, then we are, let me just say, you are right on track and you pass this examination, the upcoming ACCA financial reporting exam. Okay, just practice. You've seen that the correct figure is 747. So just do it on your own and just have to come to that. Okay, let's move on. I think the other aspect we need to talk about is the gain or loss on disposal. I think that's a very important aspect we need to cover. Let me take you there. Okay, before we get any further to that aspect, there is this important aspect as well we need to talk about. There are issues to do with fair value adjustments, and we have deliberated on some of them, but I think we need to dedicate some few minutes on this aspect. A fair value adjustment represents the amount required to adjust the relevant item from its current carrying amount in the subsidiary statement of financial position to its identified fair value. All assets and liabilities of the subsidiary have to be transferred at fair value. Important point on consolidation. Subsidiaries' internally generated intangible assets will need to be measured or recognized at fair value upon consolidation or upon acquisition. When you acquire a subsidiary, those items acquired should be measured at fair value. You will discover that some standards, for example, IAS 38 intangible assets, would not require a company to capitalize an internally generated intangible asset, okay, as an intangible asset. But IFRS 3 business combinations requires that such internally generated intangible assets should then be measured at fair value, which means they should be recognized or should be capitalized upon transfer. So you need to debit the intangible asset and credit the goodwill. Right? Now, remember, goodwill is the difference between purchase consideration and fair value of net assets. Any fair value increase is bound to reduce goodwill. So when we'll be crediting the goodwill, we are actually reducing it. Okay, so when we capitalize the intangible assets, we are increasing the intangible assets of the group, but we are also decreasing the goodwill. Similarly, on contingent liabilities, these should also be fully considered as liabilities. Although in terms of IAS 37 provisions, contingent liabilities and contingent assets, these are considered to be, these require disclosure. They require disclosure in the notes to the financial statements. But when it comes to IFRS 3, they also need to be considered as full-fledged provisions. Please bear that in mind when you face them in the consolidation question. So what is the double entry? You need to debit goodwill and credit liabilities, that is provisions. So by debiting goodwill, we are increasing the goodwill and lowering you are increasing the goodwill as well as increasing the liabilities. Okay, so goodwill is actually reduced when we increase another asset, then the goodwill will suffer. But when we increase the liability, the goodwill is also going to increase. At reporting debt, any excess depreciation should also be considered. All right, do we have an example? Let me see. Okay, we have got this particular example. Hardy acquired 80% of the share capital of Prodin on 1 January 2023 for cash consideration of 1 million. At the date of acquisition, Prodin had retained earnings of 125,000 and a revaluation surplus of 100,000. At acquisition, the fair value of Prodin's plant exceeded its carrying amount by 200,000 and the fair value of its 20% non-controlling interest was 380,000. The statement of financial position as of 31st December 2024 for the two companies are as follows. So the statements are as given. We've got that for Hardy and another one for Prodin. Now we have got investment in Prodin at cost 1,000, property plant and equipment 5,500, current assets they are given the inventory, receivables, and cash. Okay. The statements of financial position continue. As you can see, this is the equities and liabilities side. Required. Calculate the value of the net assets of Prodin at the acquisition date and date of reporting. So we are being tested on our understanding of these concepts. All right, so let us proceed to the working area. Okay, so since the question requires us to calculate the value of net assets at both the acquisition date and reporting date, therefore we should also have a working like this: net assets at acquisition at reporting. Okay, you can as well put the zeros because the figures are in thousands. Okay, now we start with the share capital, followed by, is there any share premium? No. All right, revaluation surplus. You just have to follow what the examiner has presented. Revaluation surplus and retained earnings. Yes, retained earnings. Okay, then at reporting, you just have to check or to slot in the figures as you are watching them, as you are seeing them. So let us just slot in the figures for the reporting. These figures, they are essential to us. So we are having 400, 100, 300. 400, 100, 300. Now at acquisition. The at acquisition information should be easily obtained from the question source. the initial passages to the question. All right, so we are told that when Prodin was acquired, its retained earnings were standing at 125 and the revaluation surplus was 100,000. So let us slot in those figures. So retained earnings were 125, but this one was 100, and obviously this one is not expected to change the share capital, right? But we were also told that at the acquisition, this paragraph, the fair value of Prodin's plant exceeded its carrying amount by 200,000. So we need to adjust fair value adjustment 200,000. We need to increase the value of property, plant, and equipment by that figure. Right. Unfortunately, here the examiner did not tell us about any revaluation, any depreciation issues attached to this particular plan. But let's say the examiner had told us that at the acquisition date, the remaining useful life of the plant was 10 years. What are you going to do? Obviously, you were supposed to calculate the excess depreciation related to the fair value uplift. So let us suppose that the remaining life of this plant was 10 years. So let us calculate the relevant depreciation. So we call that depreciation excess depreciation, and this is going to affect the column, the reporting column there. So that's 200 over 10, which means we are going to charge depreciation of 20,000. Okay, and this should be negative. So this should be the values of our net assets. So let me use the calculator here. That's for sorry, this one should be equal to this one, so they should be the same. It's 400. Okay, from the question, actually can be seen from the question that the share capital was 400. Okay, that's 400 plus 100 plus 125 plus 200, that's 825. Then that one is 400 plus 100 plus 300 plus 200 minus 20. That's 980. So as simple as that, you can ask this particular question. Let's move on if we have other issues. Okay. Now we're having a standard exam type question. A fair value exercise conducted on 1 October 2023 concluded that the carrying amounts of Louisa's net assets were equal to their fair values, with the exception of the following. The fair value of Louisa's land was 2 million in excess of its carrying amount. So you just have to do what we have already done. Okay, so let's do this. The fair value of Louisa's land was 2 million in excess of its carrying amount. So in this case, there has been a fair value uplift. All right, so the question requirement is that if Rudo's year end is 31st December 23. What are the relevant double entries to capture the above transaction? Okay, so all right, so let's assume Rudo is the parent, okay, because we haven't read every detail of the question. But with that in mind, okay, for now, I think we might be correct. So we need to adjust the net assets of this particular subsidiary, Luiso. So the relevant double entry should actually be, we need to debit the land, okay, debit lands, because the land has been uplifted in value, 2 million, and credit the revaluation reserve, 2 million. That's a fair deal, isn't it? Debit land, 2 million, credit revaluation reserve, 2 million. That's the double entry. Let's go on to the next one. An item of land had a fair value. Remember, land is not depreciated. So you are correct. You are ready to go. An item of plant had a fair value of 6 million in excess of its carrying amount. The plant had a remaining life of 2 years at the date of acquisition. Plant depreciation is charged to cost of sales. Here we've got depreciation, so we've got two double entries to make. Okay, the first one is as before, just similar to the above. You need to debit property, plant and equipment, 6 million, and credit revaluation reserve, 6 million. But now there is now an animal called depreciation, so there is also an aspect of excess depreciation. There. We are told that the revaluation is 6 million divided by how many years are we talking about? 2 years. So there is 3 million to be worried about. But you also have to appreciate that there is an aspect of date of acquisition. So from 1 October to 31 December, that's only 3 months. So the 3 million there should be multiplied by 3 over 12, and we should come to how much? Let us use our calculators. That's 0.75 million. 0.75 million. This is the charge to our statement of profit or loss. So what are we going to do? We're going to debit cost of sales because we are told that the depreciation should be accounted for in the cost of sales. So you debit cost of sales, how much? 0.75 million. And credit what? I don't want with my answer. Okay, we need to credit the accumulated depreciation account. Okay. You can as well use the non-current asset. You can as well use the non-current asset account as the most applicable account rather than the accumulated depreciation, just to be very specific, to show the examiners that you know what is going on. Okay, I'm trying to locate the eraser. Right, I found it. So it's not working as well, so it's fine. You can like I said, you can also just use the non-current asset, that is the plant. Okay, in as much as we have uplifted the plant's value, we can as well reduce it. Okay, we need as well to reduce it with the excess depreciation attached with the fair value uplift. Okay, now let's try the last part of the question. Rudo placed a value of 5 million on Louisa's good trading relationships with its customers. Rudo expected on average a customer relationship to last for 5 years. Amortization of intangible assets is charged to administrative expenses. I've already indicated that you might be tempted to say that no, this was an internally generated intangible asset or brand, but in terms of IFRS 3, when the company has been purchased by another, then it becomes an intangible asset. The former internally generated intangible asset would then now be recognized as a full-fledged intangible asset, which could be capitalized. So in this case, we need to do the double entry that is recognizing the 5 million as an intangible asset. So let's write it. So we are going to say debit intangible assets 5 million and credit revaluation reserve 5 million. Okay, but also remember that because of this clause that talks of the 5 years, the 5 years, then this intangible asset has got a definite life, so therefore it has to be amortized. So we just use the same principles of amortization of depreciation, that is 5 million divided by 5 years, so which means we need to be deducting 1 million every year. But remember, the acquisition date, so there were 3 months into the year, so 1 million multiplied by 3/12, that's 0.25 million. Okay, so you also need to have that debit admin expenses, because we are told that they are recognized in administrative expenses, 0.25 million, and credit the intangible assets 0.25, which means we will be reducing the intangible assets with that one. Okay, if the intangible asset account is not there, but the accumulated depreciation, amortization, then you need to put into that amortization account, the accumulated amortization. Okay, that was the basics of these fair value questions. Do we still have any other question? There is another one. So it's tough day for me. Hey, it's tough day for me. Okay, on 1 September 2028, PAMCO acquired 75% of Regressor Corp's ordinary share capital. The fair values of the net assets of Regressor and the debt of acquisition were equal to their carrying amounts, with the exception of a liability which had a carrying amount of 20,000 below the fair value. Regressor had not accounted for this fair value adjustment in its individual financial statements. It is the group's policy to measure non-controlling interests at the acquisition at fair value. As a result of the above consolidation adjustment, what would be the impact on the goodwill amount at the date of acquisition? So this time, they did not give us an asset, but a liability. So you must thank your Lord, you must thank your God for this example, because I was almost about to skip it. But I've actually determined now, I've realized this is a very important example to you guys. So let us do it together. Okay, one thing I just have to point out is that the question, although long and rambling and vexing in terms of the amount of words to be consumed or assimilated by the student in an exam or under exam pressure, the question is the very easy of questions, the very easier of questions. So we have already spoken that when assets increase, the goodwill is going to decrease. Okay? And when liabilities increase, the goodwill is going to increase. All right? So in this case, we are told that the fair value of the liability was 20,000 below market value or below fair value, which means, the carrying amount was 20,000 below the fair value, which means the liability in this case is needs to be increased. Liability needs to be increased. And if this happens, then goodwill will also increase. So what is our answer? The answer should be the goodwill is going to increase as well. So simple, isn't it? Good. Clap hands for me.